gentlemen. Welcome to this webinar on reimagining gold prices in the changing world, which is being organized in collaboration with IIM Ahmedabad and IGPC. We're going through absolutely exceptional times. None of us have ever seen anything like this. COVID-19 pandemic has impacted the world in ways no one has ever imagined. Governments across the globe have imposed lockdowns of varying severity to arrest the spread of virus. While the lockdowns are having an impact on spread of virus, there has been a severe and widespread impact on economic activity. Governments are working on unwinding the lockdowns and kickstarting the economies. The lives versus livelihood debate is raging on across the globe. Series of interventions from RBI ensured there is sufficient liquidity in the system. Immediately after the announcement of lockdown, the first set of interventions were announced by the government, which were directed towards economically weaker sections of the population. The direct benefit transfers and supply of staples through public distribution system have eased the stress on most affected sections of the population. Last week, Honorable Prime Minister announced a 20 lakh crore economic stimulus package. Honorable Finance Minister has announced today was the fourth tranche covering SMEs, migrant workers, agriculture, and today coal and mining. So this set of reforms, I mean, it's basically a combination of stimulus package plus reform that possibly should help the economy to stabilize and take us through hopefully some of these issues. Well, governments across the globe are trying to lift lockdowns. There has always been fear of second and third wave of infections, and life would not return to normalcy till a medical solution by way of a drug or a vaccine is found. There's some hope with feverish research activity across the globe to find a drug or a cocktail of drugs that would neutralize the impact of virus. And in an optimistic scenario, we could see a vaccine as early as in September, hopefully. Till the time we have to learn to live with this virus. The uncertainty has, as usual, brought into relief gold's role as a safe haven asset and an efficient hedge in times of uncertainty. Gold prices in the last 2 years have gained more than 50% in rupee terms and almost 45% in dollar terms. Sharp investment inflows helped to push the gold prices in US dollar terms to almost 8-year high. Demand for gold in India dipped, obviously. There has been a significant impact because of the lockdown. We at NSE are continuing our efforts to bring innovative products structured around gold. You will hear from us shortly on the launch of options contracts on physical gold. This is the first of its kind in India. We have already received the approval from the regulator. Some of you may also are aware of the fact that we are in the process of launching NSE Gold Standard. So far, Indian commodity exchanges were accepting only LBMA gold as good delivery on their exchanges. We have stepped out of that, and we have actually tried to define India Good Delivery Standard based on BIS standards. And we've got an international assaying agency to inspect some of the refiners who have applied to us. The process is on. We are waiting for regulatory clearance. We are also seriously engaged with the entire industry community for setting up spot bullion exchanges in Bombay as well as in Gift City. While in this background, in this scenario of absolute uncertainty, it's important for us to understand how the prices will play out for gold in the next 2 years or so. Professor Sahay and Vikram Dhawan will try and examine this issue in fair amount of detail. Mr. Kothari, President of IGPC, will give the concluding remarks. I would like to thank IIM Ahmedabad and IGPC for organizing this seminar, and then I thank Mr. Kothari in particular for supporting almost all our initiatives. Professor Sahay and Sudhish have always been with us in almost everything which we have done in the area of gold. And also, I would like to thank Commodity Participants Association of India. They have been with us in most of the initiatives which we are taking in the commodity markets. That's about it from me. Welcome to the seminar once again, and I hope you will get benefited by the insights from Professor Sahay and Dhawan. Over to Sudhish.
Thank you very much, Mr. Ravi. Without much delay, let's get on with this session. Let me ask the practitioner to start off first to give us a perspective of what's been happening over the last 2-3 years in the gold prices, and is gold a good investment option, and his views in general. To you, Mr. Vikram Dhawan.
Thank you very much, Ravi, and thanks, Sudhish. And thank you, Professor Sahay. Let me start the stopwatch because it's a weekend. I don't want to bore you much about it. So yeah, I've started the stopwatch. So thank you very much, NSC, IIM Ahmedabad, India Gold chapter, and for giving me the opportunity to address such an august audience. And thank you everybody for dialing in, rather zooming in. And I hope and pray that all of you are good and safe, and so are your family and acquaintances. Being an Indian, it always gives me a lot of pleasure to talk about gold. Obviously, we have affinity towards gold culturally, but I think there's a standing. I mean, I've been in this industry for about more than 2 decades, and there is a standing joke in our industry that whenever economic crisis happens, then Indian households, or rather the Indian women, Indian ladies, allegedly the largest holders of gold, tend to outperform everybody. In fact, while I was speaking, listening to Ravi, somebody sent me a WhatsApp in which he has said that in past 20 years, gold has given returns of 500%, whereas Berkshire Hathaway has returned only 300%. Well, with due respect to Mr. Warren Buffett. So, friends, I'll please request, there is some background noise. Can you please mute yourself? Thank you very much. We are living in very uncertain times today. And while we are getting clues of how the world may look like post-COVID, but again, at the end of the day, these are all best estimates. And today, the challenge for everyone, whether an investor or a trader or a businessman or a salaried person, the challenge today for everybody is to how to tide over this period of uncertainty. So the topic for today is reimagining gold, and gold could be one of the things which can be a friend during uncertain times. Unfortunately, in India, when we talk about gold, it's all about jewelry. More than 80% of the gold consumption in India goes for jewelry. I think we need to, it's about time that we being one of the largest consumers of gold, it's about time that we consider gold to be something more than just wearing around the neck and feeling happy about it. So let's look at gold in a different light. Let us reimagine it as an investment. So the question is gold a bona fide, viable investment? Obviously, in the limited time available, I've tried to cram a lot of things. But whenever we decide to invest into something, what we do is we run a checklist. It's like when we're buying a stock, what is the track record, what is the management, so many things. Obviously, there's not enough time to run a comprehensive checklist. But let us evaluate gold on some of the key parameters, and then let us find out whether gold is actually a viable bona fide investment, or it is simply a shiny stuff which has been around for a very long time. So let's start with a track record. What is the track record of gold over a longer period of time? Well, till 1971, rather the early 70s, US still had the gold standard, which was abolished by President Nixon. So, and in 1925, most of Europe gave it up. So what was gold standard was, it was nothing but obviously the currency circulation had to be pegged with the gold held by the central banks. So what it did was, in times like this, it crimped the capability of the central banks to print out of trouble. See, today what we are doing, the central banks, they are printing out of trouble across the world. $8 trillion and still counting. And secondly, there was a run on the gold reserves of US Federal Reserves because they were holding some very fine, good quality antique bars. So it was a cheap source of very high quality bars. So that was the end of gold standard. So let's see, after gold was orphaned and abandoned by the central banks, how it is performed. The 50-year, again, whatever returns I'm saying I have to qualify, these are all approximate. More often than not, unless I say they're in rupee terms, and obviously as we talk, market is going up and down, they will go up and down. So these are all approximate, data. So past 50-year returns of gold have been in the excess of 8%, 8 to 9%. Past 20-year returns have been again in close to 8 to 10%, closer to 10% rather. If we talk about 10-year returns, the returns are close to 6%. Obviously, we know what has gold done in the past few years. So 5-year returns are 11, 12%, and 3-year returns are 15%. And as Ravi mentioned, that in past less than 2 years, gold has appreciated by 50%. So here is a very formidable track record. But again, as part of mutual fund, it is my duty to warn everybody that past performance is no guarantee of future returns. But obviously, it's a very, 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 very formidable, profound track record. And as if you look through the periscope, as of now, it appears there's no reason why this kind of track record should not play out in the future. But I think I have to warn you for one more thing, that what we have observed and what I have been observing, or rather we have been observing in the past 20 odd years, that after every economic crisis, there is a normalization of returns in every asset class. 2001, 2008, there has been a normalization of asset class. Unfortunately, it's tapering down. So something similar may happen to gold. So while gold may have given close to 10% over a longer period of time, but I think if you maintain your expectations, return expectation from gold at the lower end, which is 8% over a longer period of time, the chances are that you would not be disappointed. And in times like this, you will be in for a pleasant surprise. What is the other attribute of gold which makes it a bona fide investment? It's liquidity, safety and security also. Now, because of liquidity, because of safety and security, gold is the only physical asset which is held by the central bank. And all large countries have been holding on to the gold reserves. They've been pretty possessive about their gold reserves. And as approximately the gold reserves held by central bank across the world is somewhere between 35 to 40,000 tons. So out of the total 2 lakh tons of gold which has been accounted for, central banks hold close to 40% of that. So why do they do that? First of all, especially in times like this, gold is very handy because gold doesn't have any credit risk. For that matter, no commodity has a credit risk, but gold doesn't have a credit risk. That takes care of the safety and security of gold is concerned from the central bank point of view. Now, in terms of liquidity, some of you or most of you who are active in the market, you would have seen that from this year, from middle of March till end of March, while the equity markets across the world and credit markets across the world were hitting lower circuits and they were getting frozen, gold market was still liquid. You could still buy and sell gold in that. So it is this attribute of gold, liquidity, which makes it a must for at least the large investors who cannot afford to do without liquidity at any given point of time. But liquidity is a double-edged sword for gold. For instance, again giving you the example of March, you must have witnessed that at some point in March, when the equity, the sell-off was at its peak, when the deleveraging was, there was a crescendo of deleveraging, there was absolute panic in the market, gold also got hammered down. Why was this happening? Because when investors cannot sell anything to raise cash or cover their margins, then they are forced to sell their gold holdings. The mentality is same, whether it is household or whether it is central bank or whether it is, it's a family office. Nobody likes to sell the gold upfront. It's the last thing that you want to sell. But if the market has gone really, the bottom has actually fallen off the market, and gold is one of the very few asset classes or securities which will still give you the liquidity. So yeah, so liquidity, and we saw this exact phenomena in 2001 and 2008 also, when there was at the peak of the sell-off, gold also got sold off. And also, when I concluded, I'll also say why this property of gold is actually driving the investors, making investors crazy about gold right now. Now, in terms of portfolio diversification and portfolio hedge, well, first of all, the investors have to be absolutely clear what they expect from gold. Is it a tactical play? Is it an absolute return play? It's a hedging play or a portfolio diversification play. I think a lot of studies have been done on portfolio diversification. I wouldn't like to, waste any time on throwing hard statistics at you. But if you're really interested to know about it, then one of the recent studies was done by the World Gold Council. It is available in their website, in which they took a typical Indian balanced portfolio, pension portfolio, with the target of attaining long-term returns in excess of 9%. And their analysis has revealed that if you add gold anywhere between 6 to 17% in the portfolio, it not only enhances the returns, it improves your risk-weighted returns, i.e. it reduces the volatility of the returns. So maybe 6 to 17 or 5 to 15. But again, I have to warn you, each portfolio is unique. Each portfolio is different. The objectives of each investor is different. If you're looking gold from the point of view of tactical play or investment, absolute returns, then it becomes a carve out of your short-term debt portfolio. If you're looking at gold from the hedging point of view, from the diversification point of view, first of all, it's never a bad time to buy gold. It doesn't matter where the prices are, but then it should mirror the risk in your portfolio. The more risk you're taking, the more gold should be there to counter it. Because at the end of the day, you need at least one corner of your portfolio which remains solvent and liquid when the worst case scenario unravels. In terms of, now again, when anyone who talks about gold, they always mention the sweeping statement about, gold is an excellent value, a store of value. Is it a myth? Is it a reality? Again, I won't throw too many hard statistics at you, but just imagine, a gold bar roughly the size of your cell phone. Smartphones are becoming bigger and thicker and heavier these days. So a gold bar, roughly the size of your smartphone, was valued at 30 lakhs 10 years back. And today it is close to 1 crore. Now, why this phenomena unfolds is because gold, more often than not, will either match the inflation in each currency, and more often will also outperform, the inflation in that particular currency. So if the long-term historic, forget about it, the headline WPI or CPI, maybe perhaps we sometimes look in the wrong places for the inflation. So if by one measure, again, this is unverified, and again, it could be my own personal opinion. If you consider the long-term inflation of inflation in India to be 7 to 8%, then you see intuitively this is what gold should give, and this is what gold has given over a longer period of time. I think the question which I am asked about gold all the time is that what is the risk of holding gold? Well, you have to understand the structure of the market. What makes gold what it is. Gold is held by very, very strong hands. As I mentioned, out of the 2 lakh tons of gold accounted for, roughly 40% of that is held by central banks. 5 to 10% of that is held by large funds, ETFs in various forms. And you can imagine it's not easy for a normal mortal to hold gold beyond a certain point. So it's held in very, very strong hands. And that also explains that why there are phases in gold, bull run, where the momentum, or rather the bull runs in gold come with very, very strong momentums. Because, it's like the Louis Vuitton and the high street stuff, the more expensive it gets, the more people aspire to own it. So and people who are buying this stuff have stronger hands. So that is why the bull run in gold will always come with very, very strong momentum, because you have people like central banks buying, you have the funds buying, you have large family offices buying, so far and so forth. To give you an example, the rally in 2019 was all about central banks. Russian central bank, Chinese central bank, they were buying a record amounts of gold. The rally in 2020 is all about investment. Even though we have collapse in the physical demand in East, which is India and China, even though the central banks have stopped buying gold because they need every cent in dollar to create a stimulus in their economy, but the investment demand has far outstripped the lack of demand from central banks in jewelry. This is the 2020 is all about investment demand. But why people are going berserk about gold? What is the reason? I mean, why this newfound craziness about gold? What is the reason for it? And for that, you have to see a little bit of history. So the very interesting statistics I'll throw at you. In 2001, gold bottomed out before Dow Jones, months before Dow Jones, and then it embarked on a 6-year bull run, giving about 250% roughly. In 2008, again, gold bottomed out before Dow Jones, a few weeks and few months before Dow Jones bottomed out, and it embarked on a 3-year bull run, returning about close to 170%. Now, if you look at what happened in March, gold made a bottom of 1450, a week 10 days before Dow bottomed out at 18,000 something. And since then, gold has rallied by $300 in no time. But again, it is my duty to warn you that no crisis, so this is the reason why gold investors are going crazy, because they have seen a similar phenomena in the past, and they think that this is going to repeat itself. That's why you'll be hearing this crazy numbers like gold going to $3,000 and $2,000 and all. Nothing is impossible in this, in this scenario. I mean, I tell everybody that we have seen a lot of strange things in the past few weeks and months. But one thing that we will carry with us and tell our grandchildren is that it was in our time that the oil prices went into the negative. So you never know. If somebody is saying $3,000 and we are laughing, it's quite possible. But having said that, it is very important to appreciate that every crisis is different. Every crisis comes with different challenges. Whether this is going to happen or not, we don't know. But certainly the gold bugs are convinced it's going to happen. Also, we don't know right now whether we have seen the worst of sell-offs in the equity market. So if the markets have actually bottomed out, if we find some sort of a cure, if there is some tapering of the infections, then perhaps gold has bottomed out, the equities have bottomed out, and both may embark on a bull run as per historical evidence. I mean, please don't take my views as something as tips for investment. But if there is one more sell-off, there is one more tail risk lurking somewhere, and if we're going to see another sell-off in equities, then there will be a time that there will be liquidity issues and people will be forced to sell their gold. Keep that in mind, when you're buying gold during distress. But again, historically, anyone who he or she has bought gold during corrections in any economic crisis, more often than not, they have outperformed, most asset classes and most securities. Also, I think, from the Indian context, we have observed a very, very strange phenomena, which at least I haven't seen since 2008 or 2011. What we are seeing is that while the physical demand in China and India has actually collapsed, but we are seeing a renewed physical demand in the West, whether it is North America, whether it is Europe, whether it is Singapore, Middle East. There is a massive demand for physical gold, form of jewelry and coins. In the month of March, even though the COVID crisis was still taking root in North America, US alone bought 4 to 6 tons of small coins. What we are seeing right now is that a renewed, interest, an absolute frenzy about gold in the West, but it's in the East where because of the lockdown, the demand hasn't actually caught up. Now the question is, and that is where it will decide the near-term trajectory of gold. Now the question is, when the lockdown is removed, will the Indian and Chinese buyers, buy the same amount of gold which they have bought historically? Will they buy more to follow their Western counterparts, or will they will they buy less because this economic crisis might have deteriorated or broken their back in terms of purchasing power? That remains to be seen. But all in all, I think today the theme is not so much about physical demand and supply. The theme is all about debt. The biggest problem today that the world is facing. I mean, there's a coronavirus crisis, there's an economic crisis, and there is a building debt crisis. As we have seen in 2001 and 2008, that the cure for debt is more debt. I mean, the debt created to save the world in 2008 has still not been repaid. The expansion of balance sheet of central banks in Europe and US still very much there, and here we are in the next crisis, where again the balance sheets have ballooned significantly, and there's a good possibility after the next boom, the next bust comes in, we would still be carrying the debt of 2019, 20, and 2008. And what happens is, when there is an excess debt, debt overhang. And also, all Western economies, if you look at the debt GDP ratio projected for all Western economies, including US, it's going to be more than 1. Every developed world, most major economies, Germany probably is an exception, would end up having a lot more debt than their GDP. The figure will be more than 1. So what it does is that it forces the central banks to keep the rates low, and for a very long time, because they don't want to serve expensive debt, and also it forces them to pursue inflationary prices. Why? Because for the debt GDP ratio to come down, you need nominal growth. And when will nominal growth come? If you have inflation. I mean, today the biggest problem central banks is that if the world goes into deflation, then the debt GDP ratio will become so bad that there'll be downgrades across the world. I mean, we are a poor country, and we are also reaching 80% debt to GDP ratio. So you can imagine that. I'm not saying that we will be having very runaway inflation somewhere end of the year or next year, but given a choice, every central bank today would like to be a dove than a hawk. So a combination of inflationary obviously now, if you in this lockdown, if you walk down and buy something, you can actually feel the inflation hitting you. So it's a combination of gradually higher inflation expectations. It's a combination of lower debt, which is not, these things are not going to go away. High debt is not going to go away anytime soon. So it's a combination of these which is giving a lot of tailwinds to gold. But having said that, gold is also a commodity. It has to be brought to for the prices to be supported. So the fluctuation in demand supply on the physical side will have a bearing, and that is why, in my personal opinion, again I stand corrected. There is a possibility that you could see gold prices remaining volatile from now to September, when we have absolute clarity on the on the lockdown issue. So yeah, so I'll just conclude with this remark that whether one should consider gold as part of investment. Well, there are other alternatives also, but I think the time has come that for Indians at least, to look beyond gold purely as a jewelry, purely as an ornament. And today we have platforms like National Stock Exchange, which are offering gold derivatives, gold listed funds. Nippon India Mutual Fund, where I come from, is the leader in the gold funds. So use this opportunity, use the platform of NSC, use the opportunities available to invest into gold. And again, I would like to tell you that don't be in a hurry to buy gold, because I give this example that if somebody would have bought gold in the last peak, which happened in September 2013, when gold prices made a high of 3,500 rupees per gram, you would have still got 5 to 6% return since then. But if you would have spread your bets over a 6 to 12 months period, you would have got double-digit returns. So spread your bets and, try to analyze how gold sits in your portfolio. Well, there are lots to say about gold, but I think it's a Saturday evening, and we have, Professor Sahay, who's on the standby to speak after me. So I leave it over here. And once we conclude, the speakers conclude, then I'll be very happy to answer any question if you have it. Thank you very much.
Thank you very much, Vikram. That was quite insightful. And as we are discussing, I got a question from one of the participants who is also a jeweler and finding it difficult during this pandemic. He sees that the sales are dropping significantly, and he wants to have some kind of returns at least for next 2 years. His question is, because the right question to a fund manager, his question is, I have quite a lot of gold in my inventory. I'm thinking to sell all this gold now. Is that a good idea? And spread it across various other assets. I want to earn at least about 10% from other assets. What would be your advice?
So, past few months as a fund house, we have been doing similar events. I've been speaking on such events twice a day. There's so much of interest in gold. And, I'll tell you an anecdote. We had this person from MS Micro, SME, and he told us a very interesting story. He says, we bought into your gold ETF 2 years back, roughly about 1 crore. And now he's sitting on a profit of 50%. So he says, should I, because he says his business is facing problems. He says, I made 50% returns. And should I sell this 50 lakhs worth of gold? He still retains 1 crore worth of gold. But this 50 lakhs he can use in the business. Our response to him was, well, it's not every day that people, make that kind of returns. So, whilst I personally remain a long-term gold bug and a gold bull, but I think if you're getting phenomenal returns in anything, there's no harm in taking money off the table. 50-60% returns, in a world where people are talking about minus 40%, if something is, hitting positive, and that too in, double digits, please take some money off the table. Where to invest is, I think that is something which is very, very tricky, and that is the individual's perception of how, as I mentioned, today we can only make estimates on how the world will look like, which sectors will do well, which sectors will not do well in the future. It's all conjecture at this point of time. And let the dust settles. Maybe you are better off sitting on gold or cash or short-term treasury. I don't know. Again, that's my personal view. I may be completely wrong.
There are more questions coming in. After Professor Sahay's session ends, there's a question related to gold-silver ratio, which I'll be coming to it later. So just be prepared on that, because people are still wondering what's happening on that ratio front. Okay.
So we'll take it later.
Yeah. Right. Professor Sahay, so we had quite an interesting insight that's coming from Vikram on, we gave perspective on the fund management side and how the investors are looking at gold. So I would like to take your opinion, particularly in the front of how central banks are looking at it in terms of on the policy making with respect to this current crisis. Am I right if I'm saying the crisis is unlike in 2007, which was more of a liquidity crisis? Are we moving to a solvency crisis? Is that right? I'm not sure. Correct me if I'm wrong. So, and secondly, what is going to be the after effect of this lockdown on the global market? So, after you, Professor Sahay.
Thank you, Sudesh. So, Sudesh, can I share my screen? I have a small PPT that I thought I would want to share with the participants.
Yeah, you have this. Yeah.
So let me start off by saying that thank you, Vikram, for that very excellent set of comments. I think I learned quite a few things over there that I had not known earlier. In my talk, I'm going to try and weave in some of those elements. That's one of the advantages of going in after some expert who has already given their opinions. I can also kind of build on those. So let me first confess that almost everyone in this audience probably has more experience in gold than I have. I'm kind of 5 years old in this industry. Probably everyone sitting here, bar 3 or 4 people, have been in this industry for 20 years or more. So my perspective is still that of an outsider, and I approach gold from a much more macro perspective, and then I try to narrow down to the micro level and see what is happening at the level of jewelry, at the level of coins and bars, and at the level of central bank buying, mining, and so on. Since I start from the macro perspective, let me start off with some thoughts on the Indian economy. How is it going to do? So about a month ago, I sat down and created some scenarios on what the Indian economy might look like in the financial year 2021. And one started out with the idea that in March, we will have about 10 days of shutdown. In April, that's the third column that you are seeing, days shut. You'll have about 30 days of shutdown. And in May, you would have 4 days of shutdown. And the shutdown would be almost complete in April, but the capacity not used would be 75%. 25% of the economy would be operating. In May also about 25% of the economy which would be operating, but that was for 4 days. In effect, right now we have 17 days of shutdown in economy. So actually our base case scenario for growth in the Indian economy is already now down to around minus 4.5%. The base case is probably closer to that should be about minus 6%, and the worst case scenario is minus 22%. I hope and pray that does not happen. So essentially, that is what we were looking at. Worst case scenario of minus 22, base case is 8%, and best case is minus 3%. That's not good news. Now, of course, this is based on assumptions. Agri and government continue to work at 50% capacity. Industry and services have borne the brunt of the lockdown and so on. We assume that 5 to 6% would have been the normal growth if the lockdown had not come in 2021. And so if you look at the latter part of the estimates, they are looking at that growth kind of coming back. In the worst case, it comes back only in the last 2 months, February and March, when you're at 95%. In the best case scenario, you're operating at that level in January, February, March. Be that as it may, we are looking at something like this. Now, if I take the middle of the range, you're looking at an economy which might contract up to anywhere between 5 and 10%. And that's for India. And if it contracts between 5 and 10%, that's actually good news, because the worst case can be much worse. What are the other countries looking at? You're looking at the USA at minus 7%, UK minus 14%, Japan at minus 5%. China, IMF is quoting 1% positive. By the way, IMF till around a month ago was quoting India at 1.8% positive. Barclays today is quoting India at 0%. Only 2 people have gone negative on India. By and large, in my experiences, IMF and World Bank start off with higher numbers and then they slowly correct, perhaps because they do not have access. And others start off at somewhat lower numbers. But the fact of the matter is that everyone is predicting a contraction. The central banks outside are also predicting a contraction for this particular year. How good are these numbers? I have no reason to believe that these are worst case scenarios or best case scenarios. I will simply treat them as base case scenarios. And so therefore, if you look at these 6 countries taken together, USA, UK, Japan, China, Germany, and India, you are looking at almost 55% of the world's economy, which is going to contract at between 5 to 10%. That's a massive contraction. So that's point number 1 that I wanted to make. The second point has to do with this issue of quantitative easing and the last 2 crises that we had and this one that we are having just now. And what is the difference over here between what happened the last 2 times and this time? So just like the last 2 times, we are also having a massive amount of liquidity being injected into the system. The difference, of course, from the last 2 times is that the real economy was not shut the last 2 times. It went on functioning pretty much as usual. in 2008-9, there was a problem in the mortgage market, which spilled over into the financial markets. But manufacturing, services, everything was on. And in the 2000-2001 crisis, again, everything was functioning normally. This time, we have shut down the economy one way or the other in some way across the world. And so this time, it's different from 2008-9. It's different from 2001 as well. It is different from everywhere, except you have to go all the way back to 1918-19 to have something similar 100 years ago, when there was the Spanish flu pandemic, which killed off 1/3 of the world, which infected 1/3 of the world's population and killed 50 million out of the 500 million people which were infected. This time, the mortality rate, of course, is much lower. However, the fear is much higher. The mortality rate, in effect, is actually somewhere between 0.3 and 0.5%. But the fear levels have been elevated to such a high level because of the reactions of the government and how the media has played it up, that we are looking at various levels of shutdown even after the lockdown is released. No economy is going to be going back to normal anytime soon. And by anytime soon, I mean 6 months, maybe a year. We will not be back to normal before September, October, November, December, by normal meaning before February of this year. So even if the financial markets come back quite quickly, the real economy is still going to suffer. I'm working with a few companies, so I was talking to some companies, consumer electronics retailer, motorcycle manufacturer, and so on. And all of these guys are looking at a 20-25% contraction. So therefore, the question that I'm asking is, how will this negative path on the real economy therefore impact the financial economy and therefore gold as an asset class? Clearly, there's a lot of money which is floating around. You have an enormous amount of money, 3 trillion from the Federal Reserve itself. You add in Japan, the Bank of England, the European Central Bank, Reserve Bank, everybody is doing their best. But the question is that money is simply solving the problem of liquidity, and hopefully the credit flow in the economy keeps flowing. How does that therefore impact A, the real economy, and B, the prices of gold, which is what we are interested in going forward? And if you look at that, the banks now are reasonably well capitalized compared to the last time around. So we don't need to worry too much about the banks, hopefully. And while one cannot really say too much with any degree of certainty, but certainly in terms of capitalization, we seem to be doing okay. The interesting thing, of course, is that if you look at the CDS spreads, the credit default swap spreads, and every time what happens in these situations is that banks tend to sit on money, right? The financial system sits on money. And I can see this happening in India. I sit on the board of an NBFC and I talk to some banks reasonably frequently. And banks are parking their money with Reserve Bank, despite the fact that the Reserve Bank is pushing them to lend by decreasing the reverse repo rate. So banks get a lower rate for keeping their money with Reserve Bank, and hopefully they'll get a better rate for lending it out. Because the problem is that they don't trust other banks, they don't trust sovereigns, they don't trust their customers, and they're just sitting on idle cash. Now, we need to find a way to get this out. And this, we are talking about India just now. What is happening globally? So if you look at it globally, with that kind of a stimulus, it will first go into the equity markets, into treasury bonds over there, equity markets, maybe even junk bonds. And then some of it will find its way, some of that money will find its way to India. That might happen 3 months down the line, 6 months down the line from the time of the first stimulus. And when that happens, the asset prices, including equity prices in India, will rise more than what it is now. Will some of that money go into gold? Now, that question can only be looked at from a behavioral perspective rather than a financial perspective. Historically, as Vikram has rightly pointed out, gold is something that we don't like to sell. We like to buy as a hedge. The mentality of households, central banks, investors, whoever it is that we want to hang on. And also, a lot of the gold tends to be held by the large guys, the strong guys. Which brings us to the interesting question from a demand and supply perspective. There was a question that came up in the chat box from Nisha, that the question essentially said that maybe about half of the gold consumption is because of jewelry, and in this period that could have collapsed completely. Is that being made up therefore by consumption, by purchase by investors? And the way the prices are holding up just now, perhaps the answer is yes for the moment, which then raises another question, which is that will jewelry demand therefore pick up in the latter half of the year once things become a little more certain? How certain will they become? As the lockdown releases, so 60% of in India, jewelry demand 60% is gold demand, 60% is jewelry, and 60% of that is for weddings. So when weddings take place, will we have the same level of jewelry consumption? That's a big question. I don't know the answer to that, but clearly part of these prices of gold will depend on that. The other part of the question that one needs to ask is, weddings are large gatherings. One of the guidelines that we can expect from the government, now enforcement is a different issue altogether in our country especially. One of the guidelines that we can expect from the government is that for the next 6 months, probably no larger gatherings than 50 are going to be permitted, even if it is for weddings. So will we have the nice big fat Indian wedding with lots of jewelry on show and so on? That's a question that needs to be answered. I suspect part of it has to do with how well jewelers address the question and how they continue to push people to buy gold. 2 days ago, I was looking at an interesting campaign by Muthoot Finance, which takes gold on collateral as a collateral for giving out loans. And they are seeing it as an opportunity to push people to use their gold to increase their liquidity. Giving out gold is good or buying gold is good. And Amitabh Bachchan is fronting that campaign. So a lot will depend on our jewelers, how they push people to continue to buy, and how the credit flow therefore then keeps on increasing in the system, unlike what you're seeing here. Again, another slide which kind of refers back to what Vikram was talking about. Debts everywhere are increasing, which means low interest rates. USA, it is like 160%. Japan, it is 250% of GDP. China is also more than 100%. India is less. But in India, gold has traditionally been used as a hedge against inflation. The point was covered very well, I thought, by Vikram, so I won't belabor the point. But given the levels of debt, it is a moot point whether gold prices will keep rising or not. And the vulnerability of the emerging and frontier markets essentially is that if you look at different countries, India and Egypt, they have fiscal sector issues. Thailand, Mexico probably have growth issues. Nigeria and Saudi Arabia are exposed to oil price declines, and Hungary and Turkey have other kind of vulnerabilities. And depending on the bond redemptions by credit spread, you can kind of classify countries into different places. And if you look at these countries, gold consumption, of course, is the highest in India. To some extent, Russia is a large consumer, Turkey is a large consumer. China, of course, is not here. The interesting thing about China is that China has been accumulating gold very, very steadily for the last 15 years. They produce around 400 tons, they consume around 1400 tons. The central bank officially has reserves of 1800 tons. I think that actually they are sitting on close to 4,000 to 4,500 tons. And private gold in China is now, if you add up the numbers imported over the last 10 years, is maybe close to 20,000 tons, which is not very far from Indian estimates of private gold in India, which is 25,000 tons. So if the investment demand that Vikram was talking about holds up for the next 3-4 months, if uncertainty does not abate and jewelry comes back, then gold prices will rise. So the question that I would ask, therefore, the final question that I would ask is, will uncertainty decrease? Going forward from now, will uncertainty relating to COVID decrease? And do we have an answer to that question? So again, let's look at some of the figures for India, for USA, for UK. As of today morning, the percentage daily increase in active cases in India is down to around 3.7%. Cumulative cases are still growing at around 5.6%. In the USA, the cumulative growth is down to around 3%. The active cases is down to around 2.5%. China is flat. So the disease itself, the rate of spread of the disease itself is now predictable to a certain extent, at least this round. The question is, what is going to happen to the behavior of people who are anticipating a second wave and a third wave of infections? The question is, what is going to happen to the feeling of people about mortality rates? I know very highly intelligent people who are so scared that they are not behaving normally. The fatality rate of this disease is 0.5, 0.6%, which actually is just 3 or 4 times that of common cold. But we have reached a point in our policy response, in the way we have looked at this disease, that people are scared. There is a mass hysteria almost. And is that mass hysteria going to go back or going to go down to a level where normal behavior resumes? If normal behavior resumes, then uncertainty will be less. That normal behavior will only resume if the leadership of countries are able to reassure people. Now that's a tall ask, because the leadership of countries has been playing up COVID-19 for the last 3 months. Now you have to reverse course and let people know that, you know what, it's not as dangerous as we thought it would be. So given all of those uncertainties, for me, so far as I'm concerned, there are 3 possible scenarios, and in all 3 possible scenarios, the price of gold actually rises. In one, the top level is probably around 2050. In the second, gold finds a new range, which is going up to 2480. The last one is the scary one, where there is a structural break and gold finds a new high driven by US-China tensions, a shift in international financial system, and resultant investment demand due to uncertainties. And there's no precedent for this price. I have no clue what that price might be. And historical precedents are not going to work because there is no historical precedent for this particular event. The only other historical precedent that is there is the pandemic of 1918, but there we had a gold standard in operation. Even though in 1922, the UK went off the gold standard, then they came back and there was all sorts of problems. Still, the US then adopted the gold standard in 1945 after Bretton Woods. So there is no precedent. And what it boils down to is, are there enough of the large investors, central banks, whose behavior is going to drive the gold prices because of the uncertainties? And are there going to be some structural breaks in the financial system because of the stresses that we are going through? And I was discussing this with Sudesh a couple of hours ago as to what the nature of these structural breaks might be. Again, difficult to anticipate at this point. And all that one can say that it is a possibility for the next 6 months. So let me close my spiel at that point. To summarize, therefore, all economies, the global economy, individual economies will contract between 5 and 10%. Banks will be stressed. There is a debt overhang. Interest rates will be high. Inflationary expectations are going to be high. Gold can form a hedge. Prices will remain because of investment demand. Jewelry demand should come back in India. The key is going forward, whether or not there is a structural break. The probability of that is somewhat low, but if there is one point in time in the last 30, 40 years that it could happen, it's probably now. So let me close at that point, and I'll hand over back to Sudesh.
Thank you, Professor Sahay. Referring to your presentations, something that I am more eager to know, and there's also a question that come up to me, isn't it more of a relative basis when you're trying to compare on the gold prices? Because in India, the gold price is definitely going to be influenced by how the currencies are going to perform. So the currency's performance is again going to be more on a relative basis, given the now that we have a new monsoon in place, that we have a debt and the deflation that is in place. So how various countries are going to manage it such that the currencies, or rather put it this way, what is the impact of currencies on gold because of the debt and the deflation scenario that is there currently? I would your views on this for next 8 months or so, because I kind of think that central banks and the governments will be in a position to manage the deflation situation maybe in the next 8 months. but debt is something that may go on building up.
So there are a couple of things which, I'm willing to stick out my neck and say that we are not about to return to gold standard anytime soon. Governments like their fiat currencies and they would like to hang on to them. They like the facility of being able to print money. For India, as an emerging economy which does not have a convertible currency, we are in a tight spot. And one of the reasons why you're not seeing a larger monetary handout in all the announcements which are happening for the last 3 days is that one does not want to be seen to be going outside certain boundaries in terms of actual direct monetary cash impact on the fiscal space within the country. So credit guarantees and food programs and so on and so forth. How the question to me is, can we be imaginative enough to use the gold that already exists in this country to create more policy space to drive growth, where gold becomes an instrument of growth for the country? And if gold can become the instrument of growth, then we might have another kind of impact on the prices of gold. Having said that, my view is that I don't necessarily see the government being able to take those kind of almost what one might consider as radical steps in these times. Those kind of steps would require being able to take a level of risk that some of our policymakers might find above their level of comfort. And so they might go for an option that is a little more stable, but still achieves at least some of the objectives. If those options were taken, perhaps the price of gold might actually come down for globally. If that kind of gold suddenly comes back into the system, price of gold might come down. But let's see.
So, but then, what's your view on the currency asset? What will be the impact on the currencies? Like, you think rupee could possibly go down or appreciate towards 70, and even if the gold price go to 2050? Is that a possible scenario?
The rupee will remain in a range unless we do something really stupid. So it will remain in a range, maybe between 74 to 78, 79 maximum for the foreseeable future. We need to do something really, really stupid. I don't see that happening. One particular aspect which we need to be careful of is, as we open up, we need to have taken into account the behavior of people. Some of the things we did not anticipate, the policy response did not anticipate during the lockdowns. As we open up, we need to take into account some things which will happen as we open up. So behaviorally, different governments actually have something called a nudge unit. The UK government has a nudge unit. The US government has a nudge unit, which is able to nudge people in a particular direction, influence behavior as an official government unit. Though I've heard people in the government talk about behavioral change, I don't know of any particular body within the government which actually has this nudge unit which can influence behavior. And so it's difficult to give you a strong answer, a very much more definitive answer. One can simply take a punt. But maybe Vikram has something that he would like to say to this.
Let me unmute Vikram. Sorry.
Okay. All right. Okay. Yeah. Can you hear me now?
Yeah.
So I think Professor Sahay really, couldn't have said, anybody couldn't have said it in a better way that he said. And this is what we are seeing. The body language of the government has been towards macro stability. Let's be brutally honest. You can either save the macros or you can save the economy. You cannot save. People is also one thing that you need to save. There are a lot of battles going on in the world to save the macros, to save the economy, to save people, and there's so many other battles as well. Now, the body language that we are seeing from the government is that it is macro first. They don't want a downgrade. which might create a turmoil in an already, sort of volatile bond credit market in India and in the currency as well. What is helping their cause is low crude oil prices also. So again, it's as of now, whilst rupee should be ideally lower than what it is, had it not been for the RBI intervention. But as things stand and as the policy is, stance stands, it doesn't look like we are going for a runaway depreciation in rupee anytime soon.
I have a question to both of you that's come from the audience. Normally Indians have been saving at least about 12 to 15% of their investments in gold. Should they be looking to increase their percentage share over the next 10, 20 years? Is the question.
So if you look at the Tarun Ramadurai report, his estimate was, that report's estimate is that Indian household wealth, about 11% is held in the form of gold. And going forward, if you look at the report, the study which Vikram cited from the World Gold Council side, which is that between 6 and 17% of the asset allocation in the portfolios of many people tend to be of gold. Going forward, and Vikram mentioned in his own talk that the higher the risk that you are taking, probably it makes sense to have a higher proportion of gold. So if you're an individual investor, this may not be a bad time to perhaps increase the proportion of gold that you have in your total assets. How much is a matter of your own risk propensity, and what is your level of comfort with gold, and how you approach investing. I know people who are very, very picky about the stocks that they pick. They will research a particular stock in great depth, and they are able to make some great picks. And if you're able to do that consistently, can gold match that return? I don't know. On the other hand, I can just buy a gold and sit on it for the next 10 years. And if you are in India, the chances are that you will at least cover inflation, but more probably you will be much better off than inflation. You will get a fairly decent return. So yes, you should have in your portfolio for sure. How much is a matter of personal investment philosophy. Sachin Agarwal is saying must increase to 25 to 30%. Now, it's your call. I don't know how much you will be comfortable with. I wouldn't go by my own advice, so you have to take that call. And as a part of investment portfolio, what percentage allocation? Again, your call. Will the price of gold go up? Yes, as IGPC, my stance is that over the next 6 to 12 months, the price of gold should go up. Despite the current collapse in jewelry demand in India and in China, it will go up for lots of other reasons.
I think one thing I'd like to add to that, and that's what we're telling people who are a lot more invested in the capital markets, that, also consider gold as a liquid asset now, because, you would need, as I mentioned in my, that you need liquidity has become a very important issue now, because as we go ahead, while the volatility may subside, but we don't know how the world looks like, which stocks, which companies, which businesses will do well, or we don't know what will happen to the portfolios. So do consider also, if you have, let's say, if you want 20% of your portfolio to be always liquid, then it should comprise of short-term debt. And how much is something that is a perception, and how much risk you're taking in the other 80% of the portfolio.
Okay, so let me get to next questions. This is more on sovereign gold bond. The question is that the better option compared to ETFs and buying physical gold if someone is looking at a time period of 7 years and more?
So, see, today we have in India now, thanks to SEBI and NSE, we have, besides physical gold, we have, gold derivatives, we have gold ETFs, gold funds, where you can do SIPs. And we also have sovereign gold bonds. That's obviously thanks to RBI. Now, it all depends, again, as I mentioned, it all depends what is your investment objectives. If you're kind of an investor who wants to buy the gold and forget about it and would never need it for the next 8 to 10 years, then gold bond is the best option. If you are an investor who likes to rebalance their portfolio quarterly or annually or every few years, then gold funds are very valuable because you will find a lot of liquidity. There are, gold ETFs are listed on the exchange, on the National Stock Exchange, and the liquidity is ample. You can buy and sell. You can even come directly to redeem and create units from the fund houses also. But those of you who are looking for tactical calls, I have a warning for you. Today, 90-95% of the short-term trading is done by machines backed by AI. So every time you're taking a short-term call on anything, gold, equity, you are up against systems and organizations which have spent millions, if not billions, on software and know-how. So you understand your odds if you're going for a tactical. And in my 20-25 years career, I've never seen people having too much of joy with gold as a short-term trading asset. Again, it is my personal experience and view, and it may or may not be relevant for you.
Now, let me get to the first question that I had regarding the gold-silver ratio. Vikram, what's your take on this ratio? Because silver is been underperforming, and the call is also joined by a couple of silver dealers and silver merchants as well. They have been wondering, very uniquely, silver prices are not moving at all. So what's your opinion on that?
So there are a couple of things. Silver went into terminal decline in the 90s when, there was the invention of digital photography. Till that time, 60% of silver was consumed for, some of you may be so young, they will not even remember those cameras that we grew up with. And after that, recently what has happened is that, we live in a world where companies have market caps of trillions of dollars, whereas the market cap of silver is, tens of billions of dollars. So you can imagine it's like a small cap fund for a BlackRock or a large. It doesn't give them. It's actually a concentrated bet. Today, silver has become a concentrated. If you're buying silver, you buy lots of it. There's a good possibility that you might end up owning a big chunk of the open interest in any exchange. So it's suffering from the reverse of the luxury syndrome. So, but having said that, silver market fundamentals are very, very strong. It's been in deficit for quite some time. And also, if that kind of deficit was there in gold, gold would have been at $10,000 per ounces. So there is, base building up for silver. It's, as I mentioned, in short term, it is very difficult to say whether the rally is going to happen tomorrow or next year or a few years down the line. So if you are an investor into silver, A, don't bet the farm on it, and B, be very patient.
Professor Sahay, this question, both any of you can take this. US Treasury yields are close to zero, so do we see a lot of fund rotation from Treasury bonds to gold? Is that something possible?
Sorry, I can't hear you, Sudesh.
The question is there a possibility of funds moving from US Treasury to gold, given that the yields are zero? Any of you, if you want to comment on it.
With your permission, Professor Sahay, can I take this?
Please.
Yeah.
Okay. Professor Sahay, I'm going to record this because you have complimented me. It's not every day that somebody of your stature compliments me. So I've recorded this conversation. Okay. So anyway, let me tell you one thing. As much as I love gold and I like gold, gold is no match for treasuries. It's a very minuscule part of, still in trillions of dollars.
Excellent.
And today you are looking at markets, $1 trillion become loose change these days, So I don't think gold has enough space for that kind of money. And the risk actually, if you really ask me, if gold doesn't, give 2 to 3x returns in the next 10, 20 years, it might go the silver way also. And that is why, there's one stream of thought that, the central banks, while in the historically never wanted gold to go up, but today don't mind, gold going up actually. So yeah, that's my take on this.
So I'm inclined to agree with Vikram. I don't see it as a replacement. The point that I was kind of trying to make when I said that there might be a structural break. That has to do with the fact that the dollar is the numero uno currency, the so-called reserve currency. Politically, we know that China would like more space to play over there. It would like its own currency to be more respected, so to speak, in the international financial system. And one of the ways to do that is to figure out a way to use something else to drive that transition. The last time, of course, that a transition happened between two reserve currencies was between the British pound and the US dollar back in the late 30s and early 40s. And the Bretton Woods system essentially kind of formalized what had been happening since the First World War. I don't see that happening just now, because if you look at the basket of currencies which constitute the foreign exchange reserves of central banks, if you look at the holdings of the International Monetary Fund and how much of the SDRs are in yuan versus other currencies, if you look at the proportion of the world trade that is denominated in yuan compared to the US dollar, I don't think that the Chinese are anywhere close to where the US had already come in the early 20s and mid 20s of the previous century. So therefore, I think right now, behaviorally, the US treasuries are the safest place to be. And I would have been much more willing to take a punt on what you have just said, maybe 10 years from now, when China would have been in a much stronger position. Right now, the Chinese economy is a $14 trillion economy. The US economy is a $24-25 trillion economy. The US spends $680 billion on defense, which is more than the next 5, 7, 6 countries combined, including China. So I don't see any big change happening over there at a macro level. But at a micro structural level, maybe, I don't know at this point. What is increasingly clear is that and we have Mr. Donald Trump to thank for this, I think. What is increasingly clear is that the US has been consistently, to use Mr. George Bush's term, misunderestimating China for a very long time as to the intentions of China. That seems to be reasonably clear. So one has to see where that goes forward. This pandemic is as much a setback to China as it is to anyone else. Let us not forget that the Chinese are also going to suffer as much as anybody else.
Okay. And now I have a couple of questions related to the policy front. One is on is there something, Professor Sahay, you would want to take? It's on the International Bullion Exchange. So the question is, if Professor Sahay can throw some light on International Bullion Exchange that is being proposed, do you think the local banks be allowed to trade, and how about bullion dealers being trading on?
I'm not the best person to be asking that question, Sudesh. I think you know that. So I'm going to pass on that one.
Okay.
All right.
Vikram, a question to you related to ETF and the MCX price and the exchange traded prices. Why does the disparity exist currently?
Okay.
Normally.
Yeah. Okay. I'll take a bit of, with your permission, Professor Sahay, I'll take a bit of that policy, if you permit me to answer that.
Please.
Yep. So see, I've worked all around the world, deep East and deep West, and I've realized one thing that we don't realize as Indians, that we have the perfect time zone for international markets, commodity, international markets, in the morning. And I work in commodity markets. My market starts at 4 a.m. in the morning till midnight. So in terms of time zone, in terms of geographical locations, we are very, very ideally suited. And there's no reason why we can have international bullion exchanges, international stock exchanges in our country. But I think it's a mindset of taxation. It's a mind of control, which needs to, change. If we can get over that, then I think it is phenomenal. Our IT infrastructure, quality, cost-effective people available in this country. It's a fabulous, fantastic opportunity for us. But again, I think we can only hope and pray for that. But yes, is it an opportunity? Amazing opportunity for, I mean, if it happens, then we'll be the first fund house to go there and launch something on that. To answer your question about the ETF, you have to understand that, India, there is not full capital account convertibility. So, you can't arbitrage from legally arbitrage from one capital market to the other capital market. So that is why the gold prices in various forms will have a life of their own. If it's an ETF, it will be driven by the physical, gold prices. If it is a derivative, it will be a function of demand supply in the futures in the forward markets. And if it is pure physical gold, it might have a slightly different life of its own, because depending upon if there is any dislocation or not. For instance, amongst us we have Mr. Prithviraj Kothari, who, of all the things, that he's the one who taught the gold business to the whole country, and he can better tell us about it. But in the month of March, this is the first time I'm seeing in the past 7-8 years, there was an absolute shortage of gold bars. There were no gold bars available for love or money. And so much so that, our ETF was at one point trading at 5% premium to international prices. So, these things happen. The reverse may also happen. If there's abundance of gold bars coming into India, then we might go into a discount. So this is what we call as a locational premium in the commodity parlance. And this is what actually makes it very exciting. And for instance, you may want to ask that why gold bonds are trading at a discount. For the simple reason they are not backed by gold, while RBI holds gold reserves, but it is not a right on gold. So they are treated as G-Secs. Similarly, so that is why investor actually today is spoiled for choice. If he or she wants to invest into gold, he or she should look at which is the cheapest option available for them on a given day.
Thank you. Thank you, Vikram. I think you answered quite really well on that. Now, may I, Rajesh, can you please unmute Mr. Prithviraj Kothari? Mr. Prithviraj Kothari, if you could help us with the closing remarks and your views
Thank you.
about today's discussion.
Thank you, Sudesh. Thank you. Thank you, Mr. Vikram. Thank you, Mr. Arvind Sahay. Thank you for your thoughts. Vikram said the bona fide investment in gold, almost in the globe, 2 lakh tons of a gold, 40% having the central bank, 5 to 10% ETF large fund. It's a gold is still having with a strong hand. For 2019, they said really central bank. 2020, really gold for investment product. US, China, India, all about central bank buying in 2019. Gold prices volatile till September. And Vikram said the gold, there is a lot of structure in a model in India, like a exchange traded fund, a gold commodity exchange, derivatives product, gold sovereign bond, gold GMS, a lot of product in India. And in second thing, एक चीज मैं कहना चाहता हूँ कि secondary market के अंदर sovereign bond की secondary market को promote नहीं किया. It's a restriction of a government side. इसीलिए वो secondary market उतनी sovereign gold bond की liquidity नहीं आ रही है. इसके लिए उसका discount rate चल रहा है compared to ETF. ETF is more some costly, but you can sell anytime and you can place each and everywhere. Thank you, Professor Arvind Sahay. जो आप गोल्ड आपने प्रोफेसर साहब को सुना होगा, उन्होंने गोल्ड पॉलिसी, इंडिया गोल्ड पॉलिसी के बारे में काफी मेहनत की हुई है. ही इज अ प्रोफेसर फॉर इंडिया गोल्ड पॉलिसी. उन्होंने 5 साल से हम देख रहे हैं और काफी मेहनत करें इंडियन गुड डिलीवरी के बारे में, इंडियन माइंस रिफाइनरी के बारे में, माइंस के बारे में, एक एक चीज का उन्होंने बहुत से अच्छा किया है. जीडीपी के बारे में उन्होंने बताया है, सेंट्रल बैंक क्यू के बारे में बताया है कि 3 ट्रिलियन यूएस फेडरल रिजर्व स्टिमुलेट पैकेज दे दिया है. इंडिया के अंदर भी बैंकों के पास काफी ह्यूज फंड पड़ा है, बट दे आर वरी. उन्होंने गोल्ड रेंज को बताया है कि 1400 टू 2015 एंड 1610 टू 2480 इफ यूएस चाइना ट्रेड वॉर हैपनिंग. गोल्ड INR USD रेंज 74 टू 70 रेंज बताया है. इंडियन हाउस होल्ड के पास 11% गोल्ड पड़ा है. तो ये बहुत सी चीजें जानकारी मिली है. थैंक यू वेरी मच प्रोफेसर साहब. थैंक यू विक्रम to hear you. Thank you Sudesh, and thank you Ravi for such a nice wonderful conference. Thank you everyone, and thank you.
Thank you, sir.
Thank you, everyone. And specifically, a special thanks to NSC and Nagendra if you're there. Thanks for taking this initiative forward and helping us get this done. It's a really good number of participants that we had, about 190 on board. We look forward to have more such sessions in the future. Until then, thank you and stay safe. Bye-bye.
Thank you very much.